Loss ratio. One of the concepts that you're going to use is the concept of companies going bankrupt. Now, you're going to emphasize on this concept through the course of your presentation on the loss ratio, and you're going to emphasize that companies do not want to go bankrupt. Now, insurance companies are also a business. So unless they generate enough premium to stay in business, and unless they generate enough premium to cover all of their losses, eventually they're going to go bankrupt. Now, you could use two insurance companies that actually went bankrupt within the last 10 years. Now, there was a company called AIG. Now, this company went bankrupt maybe 10 years ago for the same concept that they had so much losses. They paid so much money out of pocket for claims for accidents, and they weren't collecting more to balance their losses. So therefore, they went bankrupt. Now, there's another company that actually went bankrupt possibly about a year ago. This company was called Access General. Now, Access General was one of the most economical companies. Matter of fact, the rates that they offered were ridiculous. There was no other no other company out there that was able to compete with the rates, meaning they had the lowest rates across the board in California. Now, simply because their rates were so low and they weren't really balancing their losses, they kept losing money until they went bankrupt. So you're going to tell customers, look, the majority of the companies are willing to cover, $10, $15, $20,000 for an accident if that's necessary, but also for them to stay in business, for them to actually balance their losses, they're going to need to charge us a little bit more. Now, if they don't charge us a little bit more, if they don't increase their rates, that means they're losing money, and within a couple of years, they're going to go bankrupt. So you use the whole concept of an insurance company is required to stay in business, and one of the methods that they use is to balance their losses by increasing the rates. So if they have a lot of losses this month, I guarantee you next month the rates are going to be higher. So therefore, the rates are never the same. Simply, in 2018, if they lost more money than 2017, guess what? In 2019, the rates are going to go higher. Now, once again, you're going to emphasize on the fact that insurance companies want to stay in business, and the only way they're going to stay in business is if they're collecting enough premium to pay for all the losses. Now, if they're paying more money for claims, for accidents, for losses than the money that they're collecting for premium, then eventually they're going to go bankrupt. So one of the methods that they use is to balance their losses by increasing the rates. So once again, every company wants to stay in business. Use other companies in general, like Toys R Us, for instance. They went bankrupt because they weren't able to balance their operation. Now, maybe it wasn't so much about losses, but the fact that they weren't able to adapt to the online business, they ended up going bankrupt. And we're talking of a company that was in business, one of the most successful companies in the history. Now they're no longer in business simply because they weren't able to balance their operation. Now, an insurance company, the way they balance their operation is by simply collecting more premium than the losses that they're paying out. So once again, companies want to stay in business. They do not want to go bankrupt, and therefore they're forced to balance their losses by increasing the rates. So justify that whatever they were paying before, due to this loss ratio example, the rates are no longer available. So most likely they're going to be responsible to pay for a little bit more.